All right, guys, let's look at the Edmonton real estate market. Been a while since I've done an update. I missed the December and January update because I was pretty busy and was dealing with some family stuff. So definitely see a significant shift in the market since the last one I posted, and we're going to go into all of that today. As usual, I'll start with the market as a whole. So total residential, that includes stats for detached homes, apartments, townhouses, half duplexes, basically everything smushed together. And then we'll go into each one separately, starting with detached, then going into semi-detached or half duplexes, and then row/townhouses, and finally apartments. For each one, we're going to look at everything from the absorption rate, which basically tells you whether it's a buyer's market, a seller's market, or a balanced market, how many sales and active listings there are at the end of the month, the average price changes over the last year, and benchmark prices. So each one of those is useful for different reasons, but make sure you stick around to the end so that you get a full picture of exactly what's going on with the Edmonton housing market. So let's jump right in, starting with total residential. The absorption rate is sitting at 22.09%. That's actually dropped. In December, it was at 27%, which was pretty close to being like a weak buyer's market and moving into a balanced market, but it dropped again down to 22%, which puts it pretty clearly in buyer's market territory. Now, we did dip into buyer's market territory a couple times in the last year, but you can see like it's a big difference in the balance of the market compared to the same month last year. So we're looking at the January stats. We're beginning of February now, so we just got all the January stats. And you can see in January of last year, in 2025, the absorption rate was sitting at 44%, which was actually more than halfway through a balanced market. And now we're at 22%. So it's like half, literally half the absorption rate that we had before. That's a pretty significant change over the course of a year. You can see that it did kind of peak last March when it got into the 50s, like 50% absorption rate, just over 50%. So technically it was a weak seller's market, but not super noticeable. And then it kind of gradually came down. By August, it was already barely a balanced market. It dipped into buyer's market territory in September, was on the cusp in October, dipped again in November, came back up a little bit in December, and then we just dropped another 5 percentage points of absorption. So that does kind of tell you that it's not the same thing going into 2026 as it was last year. And if we went back even further, we would see the year before it was even tighter, and we had seller's market for quite a bit of 2024. So big changes here. Average price was sitting at $418,373. That's down from December. So that's down 2.33% from December 2025 and down just a little bit from the same month last year. So down 0.51% from January 2025. And if you look at this bar chart here on the right, this is just the 13-month history of the average price changes. And the reason you see it changing so much is because that's like the month over month number. So last year we saw gains in January, February, March, and April. Then there was a pretty significant drop in the average price in May, but it bumped up again in June, and then a couple negative numbers, and then up again. It's basically gonna zigzag, and that's normal just because there's different inventory that sells each month, right? So let's say in March last year, there happened to be a bigger group of higher priced properties that sold. That's gonna push the average price up. So if you're just looking at it on a monthly basis only, the average price especially can be a little bit wonky. So you don't wanna pay too much attention or put too much weight on any given month for the average price, but it's still helpful to see, okay, are we up or down from last year? You know, we're down slightly from last year. You know, we're down from last month. The next set of bar charts will actually tell you the average for the whole year, which is a little bit more useful. It's a cumulative number. So for 2026, we only have the one number so far, and that's the down 2.58% for the year. But that's just taking 1 month into account so far. The other years before this are a lot more useful. So 2025, you saw that we were actually up 5.41% on average. And 2024, we were up 7.89% on average. If you go back further, you can see 2023 was a year that had a loss on average of 4.62%. And again, it was up in 2021, 2022, and 2020. Later on, we're gonna get into the benchmark pricing, which is a lot better than average pricing because it's not as skewed by, low-priced properties or high-priced properties kind of messing up the average. So that's a bit of a deep dive on average prices there for you. Now, number of active listings at the end of January was sitting at 3,581. and there had been 791 sales. Active listings are up 7.47% from December. Nothing crazy there. Usually December is one of the lowest months of inventory. Not everybody wants to sell their property in the winter, especially over Christmas. But that inventory is up significantly from January 2025. It's up 35.8% from January 2025. Now, I don't remember the exact numbers, but pretty much for all of last year, all of 2025, when I was comparing it to the year before, we were often, I think, up mid-20s to around 30% in inventory from the year before as well. So we're kind of seeing the same pattern. But if you take that 2 years in a row where, you're ending up with 60% more inventory than you did 2 years ago, that starts to make a massive difference in the balance of the market. Now, the same thing with sales. The sales were down 13.36% from December and down 33.02% from January 2025. So you can imagine what happens to the market when you have inventory going up by, a third or 2/3 over 2 years, and you have sales dropping by a third or 2/3 over 2 years at the same time. That basically brings you from like strong seller's market territory to, the other end of things where you're actually in a buyer's market. So no surprises there. Real estate does move a lot slower than stock market and stuff like that. So it takes time for these shifts to kind of play out. Edmonton's market's still performing much better than pretty much the rest of Canada. But there's no doubt that our market has definitely slowed at this point. Now, average days on market was sitting at 61 days in January. That's up from 49 days in December. So actually pretty big change month over month. But again, just 1 month, don't give it too much weight. If you compare it to January of last year, it was at 48 days. So that's like 13 days more on average compared to the same time last year. And if you look at the months of February through May, you can see we had like 37, 31, 30, 30, 32. Those were much lower. In some cases, like half of what we're sitting at right now. So far, I'm not expecting to have quite the same year as what we had last year, unless a bunch of buyers come out of the woodwork. Those average days on market, I think, will stay elevated. Probably not as high as 61 as we get into the spring, but I don't think it's gonna get down to the 30 range like it did last year. Now, market distribution, this is basically just the price point that properties are selling in. Again, this is all of the inventory that's sold in Edmonton. So under 200K was 13.65% of sales. 2 to 300K was 16.56. 3 to 400K was 19.47%. And then the biggest segment was between 4 and 500K with 22.38% of sales in January. Then it drops off from 5 to 600K, but still a significant part of the market at 15.68%. And then once you're in the 6 to 700K range, it's a much smaller part of the market, 5.44% of transactions. And then 7 to 800K is 3.16% of transactions. So after that, it's pretty negligible. Now, since we're looking at the market as a whole, what I like to look at for the benchmark pricing, which I said is generally much better pricing tool than just average prices, we're gonna look at the composite benchmark price and how that's changed. So you can see in January 2026, the composite benchmark price was sitting at $399,400, which is actually down quite a bit from the peak in 2025. We peaked in June 2025 at $426,600. It had kind of been pretty close to around that number a couple months prior to June as well. So that would have been April, May, June is when it was kind of basically at its peak, not moving much. And if we compare this January pricing to last January pricing, you can see that we are down in the benchmark price. So we're at $399,400 right now. And January 2025, it was actually at $408,000. That's down $8,600 from the same month last year. And what's interesting is you can also see that just how the line had kind of went vertical right before that January 2025 number. So December pricing was actually significantly lower, like not last month, but the year before. Whereas that's not the same pattern that we've been seeing so far. It's been not a huge change in pricing since December. So that tells me it's definitely not going to be the same year as it was last year. Now, we're still above peak 2024 pricing. June 2024 pricing was sitting at $396,900. So, pretty close to peak pricing in 2024, slightly above that, a few grand. And I didn't actually label the number on here, but you can see that is also below peak 2022 pricing, which is when we had one of those peaks. So we were above peak 2022 pricing for quite a while. I don't know, not quite a while, half of the year in 2025, but now we're back below that. That's it for the market as a whole. Now let's start getting into the nitty-gritty details for specific property types. And the next one's going to be detached homes. Single family detached homes were sitting at an absorption rate of 23.6%. That's also buyer's market territory. Not like super strong buyer's market territory, but it's still there. That was not true last month. In December, it was at 31.22%, which was like a weak balanced market, so borderline buyers, but that's, you know, a 7% drop just in 1 month in the balance of the market. And it's the same story here with detached homes in terms of the pattern as what we saw in the market as a whole, and which is not crazy. The detached home market is like a very big chunk of the housing market in Edmonton, like probably half of it kind of thing. So it's not crazy to see that it's following the same pattern as the market as a whole, because it's, you know, influencing that strongly. Again, just to reiterate, you can see that January last year was at 44%, so almost half the absorption rate as the same time last year. We were in balanced market territory for most of the year, and it dipped down into buyer's market in September for the first time, and then again in November, and now in January. But it's the lowest absorption rate we've seen in the last 13 months. Average price for detached homes was sitting at $541,503, which was down 1.93% from December. So down close to 2% from last month and down 2.23% from January of last year. We are seeing a couple percentage down in the last year on average price. We'll take a look at benchmark later. Now, if we look at the year average prices, so far for the year, we're down 2.77%, but that's not very important yet. 2025, we were up 5.85% on average, and 2024, we were up 8.87%. You can see that there was also about a 2% drop in 2023, and then 2022, we saw 4.89 increase, and 2021 there was a 7.15% increase. So depends on the year. Now, actives and solds for detached homes, there was 1,733 active listings at the end of January and 409 sales. So the active listings were up 7.77% from last month. Nothing too crazy there seasonally, but up 31.59% for the year. Again, same pattern as the market as a whole. Pretty big shift in inventory, and I believe that was similar to this shift that we saw from last year compared to the year before that. Now, sales are down 18.53% from December and down 30.32% from January. Again, same pattern. Average days on market was sitting at 55 days versus 50 days in December and 50 days last January. So for the detached market, it's actually not that much of a shift compared to January in terms of how long it's taking the properties that do sell to sell. The one thing I often like to point out about days on market is it only counts for the ones that sell. So if somebody lists their property and it sits for months and months and months, and then the listing expires and they never sold it, that doesn't even go into this calculation. So keep that in mind. Now, market distribution, less than 1% under 200K. So good luck finding a detached home under 200K in Edmonton. 2 to 300K is also almost nothing now, 3.91% of the market. 3 to 400K used to be a more significant part of the market, but those got pushed up. So 15.16% of the market between 3 and 400K. Largest segment was between 4 and 500K with 30.81% of the market. And the second largest was between 5 and 600K with 25.92% of the market. And then 10.27% between 6 and 700K and 6.11% between 7 and 800K. After that, pretty negligible numbers. Now for detached homes, I'd like to look at the benchmark pricing. And we've got two different ones to look at, which is nice. So we can split it up into 1-story detached homes and 2-story. So 1-story is going to include, you know, bungalows, bi-levels, pretty much anything where you just have one level and your basement, because almost all houses in Edmonton have basements. There are a few exceptions, but those are not going to really follow this exactly. And then 2-story homes is kind of the most common type of modern home in most cases. You got 2 stories plus your basement. So we'll start with 1-story. So the benchmark price in January 2026 for 1-story homes was sitting at $439,200, which has come down a fair amount from the peak in 2025 when it was at $477,900. If we compare it just to the same month last year, so January 2025, it was sitting at $449,400, about $10,000 lower than it was same time last year, but still significantly above the July 2024 peak, or what the peak was in 2024 when it was sitting at $422,000. So even though we've seen some drops from the peaks of this last year, still ahead of the game in pricing compared to 2024. And I didn't plot it here, but you can see over here at 2022, it's also above the peaks of 2022, just like the 2024 numbers were above those peaks as well. So we're still quite a ways above, like not a huge amount. Like that looks like that's at like, it looks like the peaks in 2022 were probably like 415. Not a huge amount, but still above those peaks, which is definitely not what you're seeing in markets like Vancouver and Toronto. Now for two-story detached homes, January 2026, benchmark price was sitting at $560,700. The peak in 2025 was 586,000, I think, 86 or 88,700. And January 2025, it was at 560,600. In the case of two-story detached homes, they're pretty much on par with with pricing in January of last year. So even though it was above for a while, it came back and we're back where we started last January for two-story homes. Still above the 2024 peak, which was June 2024 at $546,400, and still a little bit above the April 2022 peak of $549,800. So we're about 10K above the peak in 2022 for two-story homes. So that's it for the detached market. A couple other comments here. Just the way things are shaping up so far and kind of what I'm hearing. This year, there's going to be a lot of people doing their mortgage renewals. I think it's the highest number. I don't know if it's a record number, but it's the biggest group of people that are having to renew this year compared to like last year or next year, that we're going from a much lower interest rate to an elevated interest rate. So there's going to be some people feeling some pain at renewal time. And that can have an impact on what we see in the market, right? So there's going to be some people, obviously there's going to be a bunch of people that just renew. You know, they take the hit, they have their increased monthly payments. They've had quite a bit of advance notice, so it shouldn't be a huge surprise unless they've had their head in the sand. But it might still be a surprise, right? Like a lot of times people do stick their head in the sand and they're just kind of hoping rates will come down or whatever. And they're looking at the Bank of Canada announcement and all that kind of stuff. But the reality is anybody that was on a 5-year that's renewing this year is going to see a substantial increase in the mortgage payments. And some of those people are going to decide to sell. Now, does that mean the market's going to crash? No, but that can start to have an impact on the balance of the market. So we've already seen the balance of the market shift substantially in the last year. And if you look at it over the 2 years, it's a really big shift, basically from seller's market to buyer's market territory. Now, if this year we're running into a period of time where we're going to see the highest number of people renewing, that could have a further impact on who's listing, right? So people are getting their renewal notices and they're like, wow, I can't afford that. Or, you know, maybe we should sell and rent for a while. Maybe some people will downsize. The people that are downsizing, like if they're selling and buying something cheaper, in terms of how that impacts the market, like it's still, it means 2 sales end up happening ultimately if they're successful. So that's not necessarily a bad thing. But if somebody's just getting out of the market altogether in terms of ownership, they just want to sell and go back to renting or something like that, maybe they're forced to sell because it's just too tight for them, that could start to bump up the number of average listings that we have, which can shift the balance of the market. So if that happens and there's not a huge influx of buyers, that could cause further price drops. Now, this is unconfirmed and I have to do more research on it, but I've also heard from some people that deal with foreclosures is that it looks like there's going to be a fair amount more foreclosures this year than what we've seen in the last couple of years. This is something people have been speculating about for a long time, that like, oh, because of the increased interest rates and all that kind of stuff, a lot of people were expecting like an avalanche of foreclosures, and it just never really happened. Like there's always some foreclosures, but there haven't been that many, I would say, over the last couple of years, especially compared to the way some people were talking about it. So a lot of people make assumptions about that. But this year, we might actually see a good chunk come through just based on some things I'm hearing. Again, I haven't confirmed. I'm sure there's some stats out there that might be available, if not now, maybe later. But my takeaway from that, if that is true, is that this stuff takes time, right? Like it's not like people, as soon as the interest rates goes up, like all of a sudden, all those people, like everybody has to start paying more for their mortgage payment and then a bunch of people get foreclosed on right away. Like it takes a while for the financial situation to deteriorate. And if they didn't have their renewal right away, maybe they didn't get a renewal until last year, or there's some people getting that renewal this year, and then it can take like a year after you fall behind on your payments to actually get foreclosed on, and that be a property that ends up on the market. So that'll be something to look out for as well. That could add to the inventory. Again, I've heard there's a lot more coming this year, but I don't think it's going to be an avalanche, but we'll see. So something to keep in mind as well. I would say that's linked to more of the people having to get those higher mortgage payments, and then it taking a while, and it just takes a while for it to kind of roll through until those show up. So I'll be curious to see if we actually do see significantly more foreclosures this year, but previously there hasn't been that many compared to what people were expecting. So time will tell. All right, so that's my ramble for that. Let's get into that semi-detached or half duplexes. So this is sitting at a 23.81% absorption rate. So that's also buyer's market territory, down slightly from December when it was at 25.46%. Basically following the same pattern. January of last year it was at an almost 70% absorption rate. So like almost a third of the absorption rate of what we had last year for the half duplexes. This is a much smaller market, but that's a massive difference in the balance of the market just over the course of a year. It was still strong seller's market territory until May. Then it started to shift and it was barely seller's market, mostly balanced, and then we dropped into buyer's market territory 2 or 3 times in the last 4 months only. So it took a long time to switch, but now it has switched. It's technically a buyer's market. Average price sitting at $407,760. That's down 3.52% from December and down 3.66% from January last year. You can see that depending on the month, sometimes you're up, sometimes you're down. Average price in 2026 so far is down 5.24%. 2025, we were up 4.77% on average, and 2024, we were up a whopping 9.07%. 2023 was down slightly, down 0.79%. 2022 was up 7.71% and 2021 was up 4.57%. If you look at the 4 years before that, there was some moderate losses in average price there as well. Now, actives and solds. First thing I'll point out is there was 357 active listings and 85 sales. If you compared that to the detached numbers, this is a much smaller market, way less of this product on the market. Month over month change in active listings is up 9.51% and it's up 69.19% from January of last year. So it's like the inventory is up almost 70% in 1 year for half duplexes. But there's still only 357 of them. It's not like there's a bazillion. Now, sales at 85 are down 2.41% from December and down 42.18% from January. So when you have sales drop 42%, it's not crazy to see that the inventory goes up a fair amount, right? Like even though there's more people listing, when you have that big of a drop in the number of sales, that's gonna start translating into higher active inventory on a month over month basis. That explains the absorption rate changes that we saw over the last year. Now, average days on market was sitting at 52 versus 42 last month and 40 in January of last year. You can see how tight it was in February, March, and April and May when it was all under 30. We hit a low of 24 in March. That's pretty tight. So, you know, taking longer to sell. Now, if we look at the market distribution, under 200K, 2.35% of the market, 2 to 300K, 10.59% of the market, 3 to 400K, 34.12% of the market. 4 to 500K is the biggest segment with 35.29% of the market. And then 17.65% between 5 and 600K, and then pretty much non-existent for higher price points. I unfortunately do not have benchmark pricing for semi-detached, and it's basically because it's not a big enough market for them to track, or they didn't feel like it was big enough to track. So that's one of the things they don't track in the home price index, unfortunately. So you just have to rely on the average prices and kind of what you're seeing in general with the balance of the market. But let's get into row/townhouses. So most of these are going to be townhouses that are condos, but it should also include residential attached row houses as well. Now the absorption rate was sitting at 26.05%, so a little bit better than the other 2 markets that we've looked at so far, but still technically a buyer's market. Not like a super strong buyer's market, but it's technically there. You can see just in December, it was a balanced market at 31.12%, and it was on the cusp in November, kind of also on the cusp in October, but it was balanced every month before that. And you only have to go back as far as June for it to actually be a seller's market, and it was a seller's market in January of last year as well. So we went from pretty strong seller's market territory to balanced for a handful of months to now buyer's market. So that market's also seen a huge shift in the last year. Average price was sitting at $295,143. So that's technically up 0.54% from last month. December was also up, and you can see it was also up the January before, but overall month over month, it's up, like I said, but year over year, it's down. So year over year, it's down 1.81%. Take that for what it's worth. Average prices so far for the year are down 0.63%, but they were up 4.63% in 2025, and they were up 11.54% in 2024. Actives, there was 522 active listings. So again, you can already see this market's bigger than the half duplex market, and there was 135 sales or 136 sales. So Month over month, active listings are up 4.82% from December and up 80% from January of last year. And sales were down 12.26% from December and down 26.88% from January of last year. So even though sales are down significantly, they're not down as much as inventory is up. So that's really what has been the biggest contributor to this market. The townhouse market seeing a big shift in the absorption rate is obviously a lot more people listed those townhouses this last year. And that's what's resulted in the market that we have now. Average days on market was sitting at 71, which I'm almost skeptical of that. Maybe January was just a bad month. But yeah, 71, I'm a little skeptical if that's actually accurate or if there was a mistake in the calculation here, but we'll take it for what it's worth. 71 compared to 46 days in December and 37 days last January. So big shift there. Month over month, saying it's up 54%. Yeah, it's just such a big shift in 1 month. So either that was inputted wrong or it was just a really slow month, and that up a lot from last year as well. Market distribution, under 200K, 11% of the market, 2 to 300K, 39.71% of the market, and 3 to 400K, 39.71% of the market. So exactly the same percentage for between 2 and 3 and 3 and 4. Could be, but I'm a little skeptical. Generally, it's going to show you that that's where the biggest segments are anyway, 2 to 3 and 3 to 4. And then you got 9.56% between 4 and 500K. Now, luckily for townhouses, I do have benchmark pricing. And you can see in January 2026, the benchmark price was sitting at $272,600. And in March 2025, which was the peak for 2025, it was sitting at $296,000. So we're down a fair amount from the peak in 2025. That's over 20K. 24K, 23.5K. So, you know, that's significant for a townhouse on what you've seen from peak to where we're at now. We're down slightly from the prices in January of last year when it was at 275, 100, but it's pretty close, like a couple thousand basically. And you can see we're still well above the June 2022 peak when we were at 241,500. As many of you know, the townhouse market was ripping for a while, but that has partially adjusted and corrected. We'll see where this goes for the rest of the year. So far, we've been seeing some pretty significant shifts in both inventory and sales. If that tips in either direction, you know, things could get better or worse depending on how you look at it. Now, let's look at apartments. Apartments, we're sitting at a 16.36% absorption rate. No surprise here. Still right smack dab in the middle of a buyer's market. There are some exceptions to this. I've noticed, surprisingly, that 55 plus buildings, not all of them, but a lot of them are actually doing okay. Like those ones are easier to sell than a lot of other more typical apartment condos. So maybe that's because there's a bunch of boomers finally downsizing. I don't know. But those ones, you see them move a lot quicker. They don't feel nearly as much like a buyer's market as, you know, something in a typical high rise or a newer last 10 to 15 years apartment complex that anybody can buy in. But those 55 plus places, I've been seeing those ones move pretty good. But anyways, it is technically buyer's market territory for the market as a whole, but that's not a surprise for the apartment condo market because it's basically been like that all year. It might be the lowest in the last 13 months, and it's still actually a lot lower than it was last January when it was on the cusp of being a balanced market. But we've been seeing this for the apartment condo market for years now, where it's basically buyer's market for a long period of time, and there's a couple times throughout the year it bounces up into balanced market territory, but it kind of always goes back. And that's simply just because there's a lot of people that still want to sell their apartments. It's the second biggest market segment in Edmonton next to detached homes. So there's a lot of them on the market. The sales volume has just not bumped up enough to take a serious dent in that for an extended period of time. And more sellers keep coming to the market. Now the average price was sitting at $215,275. This shows that being up 10.9% for the month. So obviously either a bunch of high roller apartments sold in January or a bunch of low roller apartments sold in December. and you can see the price was down 4.62% in December. So that might have been exactly what happened. So again, don't take it too much weight in that. We'll look at the benchmark price here shortly. But yeah, year over year, up 5.25% from January last year. It won't feel like that in reality. 2026 up 4.76% so far. We were up 4.78% for 2025 and up 6.65% for 2024. I also find that kind of misleading. I think there's just been more of the higher luxury places selling than there was before, and that's kind of artificially bumped the numbers up. But in pretty much all cases when I've been selling an apartment condo or helping someone buy one, the prices do not feel like they are going up right now or that they have been in the last year or two. Now, active listings. There was 984 active listings at the end of January and 161 sales. So the active listings are up 7.31% from December and up 14.42% from January. And the sales were down 7.47% from December and down 38.31% from January. So again, pretty similar. Like we've basically seen in every market segment, give or take, being down in sales by 30-ish%, sometimes more, and up in inventory, also sometimes in the 30-ish percentage range. This one's actually up a lot less compared to other market segments in terms of the listings. So it's up 14.42%, whereas some of the other ones we saw much bigger increases in inventory. So there hasn't been nearly as big of a shift in the apartment condo market compared to all the other ones, because it's been in buyer's market territory the whole time, right? Or almost the whole time. So no big change there. Average days on market was sitting at 70 days in January, also slow. It was sitting at 52 days just in December and 57 days in January of last year. So again, January appeared to be a slow month for average days on market. Something to keep in mind is a lot of the sales that are going to happen in January are properties that were probably already on the market in December. And a lot of December and the early part of January is a bit of a write-off, right? Like as you get close to Christmas, the market kind of just dies for a while and it doesn't start to wake up again until the second week of January. And it doesn't like wake up like it had a Red Bull. It like opens one eye and starts kind of wandering around. That's probably not the best metaphor, but that could help explain that kind of peak in days on market in January, because you have several weeks there that are kind of a write-off for most properties. Now, market distribution under 200K had 54% of the market, biggest segment. 2 to 300K, 32.3% of the market. Big drop once you get to 3 and 400K, 5.59% of the market. 4 to 500K, 4.97% of the market. 5 to 600K, 1.86%, and then very negligible after that. Now let's look at benchmark pricing. Benchmark pricing in January 2026 was sitting at $191,100, which makes it look like it's down a lot from the peak in June 2025 when it was at $218,100. If you've watched any of my updates, you'll see that I basically never believed that June peak. They made it look like it just like shot up like a rocket and then happened to get, like drop aggressively, I think, in the early fall. That didn't happen. That's the only thing I can really say. You can see us in January 2026 are basically on par with January 2025 numbers when it was at $191,700. So pretty much no change in pricing over the last year. Although there would have been some monthly changes, it never went like this and then back down. Nobody that I know got a massive sale in June and then, you know, everybody else sold for way less the next month. Something skewed the data there is all I can kind of come up with. It's been pretty flat, sometimes still feeling like you're down if you're just looking at where you're at in a building compared to the year before. But that's what the numbers say. You can see we're still, you know, above the June, you can't even call it a peak for apartments, but I put June 2022 numbers on there because for a lot of people that's kind of what they think of as the peak, or most of the other markets, the peak was around April, May, June 2022, or one of the peaks was. That didn't really happen for apartments, right? Like it was a little hump, and then there was also a little hump the year before, and then they were in more shape, and then they actually saw some more gains since then. And that's just because this market's been behaving so much differently than all the other segments. It never saw those crazy price gains in 2022 like we did for a lot of the other markets. Not a huge comparison there, but we're up compared to that time that a lot of people think about. Yeah, that is it for the Edmonton housing market update. I am a real estate agent here in Edmonton and surrounding areas. I service Edmonton and anywhere that I can drive in about an hour-ish, including acreages and all that kind of stuff. So if you're looking at buying or selling or investing in the Edmonton region, highly recommend reaching out to me either on my cell at 780-819-5508 or go to booktrevornow.com and you can just select a time on my calendar and book a free 30-minute strategy call. You can ask me anything you want. I usually start off pretty casual, kind of find out where you're at with things, what's your plan, what are your goals, and then just kind of get into answering your questions and seeing how I can help you. There's no obligation to the call, but usually if we hit it off and we kind of come up with some good action steps, many people that do call me or book a call, end up becoming a client. And it is one of the best ways to get started. Don't hesitate to reach out. Like sometimes people feel like they're not ready because, you know, I'm not ready for a few months or 6 months or a year, but real estate is a slow game. So I'm totally used to talking to people like well before they're actually ready to pull the trigger. And there's a lot of things that I can do to help you for those moments. Sometimes it's on the financing side, sometimes it's on the market education side of things or pricing, helping you kind of see what to expect. It's not uncommon for people to have an idea in their head on, you know, what are they going to be able to buy a place for, or what are they going to be able to sell a place for, or what's it going to cost, all that kind of stuff. And bringing me into the conversation early can really help smooth things over for you. That's a big part of my job, is making it easier for you so that it's less stressful and I can get you the resources and answers that you need to make good real estate decisions. So I'm looking at this stuff every day. Everything that I showed in the video today is good overall general thrust of what's happening in the market, but there's exceptions in pretty much every segment. Some neighborhoods are doing great, other neighborhoods aren't. On here, it might look like, for the apartments, for example, I talked about how it's a little different if you're selling certain types of properties than others, right? So all that stuff varies depending on the market segment, the price point, the areas. And those are things that I can guide you on a lot more specifically if we're actually working together. We hop on a call, maybe we hop on a video call, that kind of stuff. So looking forward to hearing from you. Again, you can reach me on my cell at 780-819-5508, and I'll see you on the next video. Thanks for watching.